Welcome back to the Wealth Planning Podcast with Brister Law. I'm your host, Anthony Brister, tax attorney, asset protection specialist. Today's episode is for you business owners who want to keep more of your hard-earned money. The tax year has already ended, but that does not mean you're out of options. You still have time to make powerful tax moves that can save you thousands. Stick around. I'm going to talk about the best last-minute deductions business owners can make, retirement strategies that can slash your tax bill before filing, IRS-approved loopholes most business owners miss, and how a cost segregation study can create massive tax-free cash flow for the right real estate investor. If you're serious about lowering your tax bill legally and strategically, grab a notebook because I'm about to break down everything step by step. First up, let's talk about the retirement contribution strategy. So if you're a business owner and you haven't maxed out retirement contributions, you still have time to do that. It's one of the best ways to lower your taxable income after the tax year has already ended. Here's the deal. If you have a traditional IRA and you're under the income limitations, you can contribute up to $7,000 or $8,000 if you're over 50 until April 15th. If you're self-employed and you don't have an IRA or a retirement plan set up, you can actually set up and fund a SEP IRA up until the tax deadline. So if you file an extension, you actually got until you file that to fund that. The best part, you can contribute up to 25% of your salary, maxing out at around $69,000, and it's 100% write-off. Personally, I think there are better vehicles out there like the solo 401k, but if you didn't have anything in place, the SEP IRA or SEP is a good contribution or a good strategy to use. If you're an S-Corp owner, just make sure you need to pay attention. You need W-2 wages to contribute to the SEP IRA. So if you haven't taken any W-2 salary yet, you might need to get strategic about how you do that. So what do? Well, be sure to talk to your CPA or tax strategist. Calculate how much you can contribute before the deadline. Every dollar that you put in reduces your taxable income. This is a no-brainer. Next, let's talk about business deductions that you can still claim. You might be shocked how many business owners leave money on the table by just missing these deductions. And you want to make sure first off that your books are in order and you've captured all expenses. So first up, let's talk about one. It's a home office deduction. If you run your business from your home or you have an office for administrative purposes and management purposes, you can claim a portion of your mortgage or rent, utilities, internet, even repairs, but only if you document that properly. Next up, let's talk about equipment purchases. Did you buy a laptop, office furniture, business equipment in December, but forget to deduct it? You can still write that off under Section 179, which means that you get the full deduction immediately in the same year. Next up, we've got the auto deduction. So if you use your personal car for business and didn't track mileage, you can reconstruct it using your appointments and meetings. The IRS allows this if your records are reasonable and you can substantiate them. Next up is meals and entertainment. So business meals are 50% deductible, but company-wide meals like holiday parties or kind of one-off trainings, things like that, could be deductible. Entertainment currently is not deductible. And then last up, we've got the Augusta Rule. So if you owned a business and you own a home, you can rent your home to your business for up to 14 days per year, completely tax-free. If you didn't take this deduction last year, make sure to go back, see if you actually held business in at your home, plan for this going forward, but you definitely want to have this in your tool belt. So every single one of these strategies puts more money back in your pocket, but you have to be proactive. So third, let's talk about the Real Estate Tax Hack. And this was really the cost segregation study. First up, what I want to say is that cost segregation studies get oversold a lot, and not everybody can benefit from a cost segregation study. It's kind of three people who generally will benefit from the cost seg, and that's going to be real estate professionals, if you've got a short-term rental, or if you're doing a self-rental. So real estate investors and business owners who own buildings, make sure to listen up. If you own a commercial property or rental real estate, you might be missing out on a massive tax saving by not doing a cost seg. Here's how it works. So normally real estate is depreciated in over 2 time periods, 27.5 years for residential or 39 years for commercial. But what a cost segregation study does is it reclassifies part of the building into 5, 7, or 15-year categories, which allow you to write more off up front. And with bonus depreciation, you can actually write up that 15-year property, just depending on which year we're talking about. You might be able to write off more of that, a bigger percentage. Last year was 60%. With Trump being elected, it might come back to 100%. So just be mindful of which year you're in and the tax code. So who qualifies or who should really think about this? Again, it's business owners who own their own space, real estate investors or professionals with a lot of rental properties, and if you remodeled or did something like that, you might want to consider that too. If you haven't looked into this, you might be leaving money on the table. The best part, you can do a cost segregation study on past purchases. You can even do it before your year end or after year end, right? So you can still get the benefit even if you didn't get that cost seg done last year for the last year's tax savings. So if you're interested in learning how a cost seg could help you, if you're a real estate professional and you're not really clear on how this could, call my office or go to bristertaxlaw.com, schedule a discovery call. So the next thing that we have that could really lower your taxes is for those operational business owners, and it's about your structure. If you're in the wrong structure, it can play a huge role in how much you pay in taxes. If you're still in LLC tax as a sole prop, you're definitely paying too much in self-employment taxes. So what's the solution? Well, it's to make a retroactive S election. It allows you to take part of your income as distributions, which aren't subject to the self-employment tax, and then you only pay the self-employment tax on your reasonable salary, so not your full income, where if you're a sole prop, you'd pay it on all of your income. If you made over $50,000 in net profit and you haven't switched to an S-Corp, you need to talk to your tax strategist now because you're paying too much in self-employment taxes. All right, so let's wrap this up. Even though the tax year is over, you still have options to save thousands, but only if you take action now. Contribute to your retirement account before the deadline. Make sure to claim all the business deductions that you might miss. Scrape your books. Consider a cost segregation study if you're one of those 3 categories I mentioned. And fix your business structure to lower your taxes next year. If you need an expert tax strategist to make sure you're paying the absolute minimum, schedule a consultation with my team at bristertaxlaw.com. And before you go, like, subscribe, share this episode with someone who needs it. We're here to help business owners legally lower their taxes and build long-lasting generational wealth. Until next time, I'm Anthony Brister, helping you protect your assets, maximize your wealth. We'll see you next episode.